Let's talk about Havells now. Third quarter was weak for the quarter. The cables and wires business dragging overall revenue growth. Margins were also under pressure. We have the management now joining us, Mr. Anil Gupta, Chairman and Managing Director at Havells, taking us through what to expect. Mr. Gupta, it's good to see you back on CNBC-TV18. It's a while we spoke. Prashant this side. So in the first quarter, sir, you had guided that the next 3 quarters will be stronger. But in the quarter that you reported numbers for, the cable and wire segment has been a bit of a drag on growth. Could you tell us what has happened and how is this quarter now looking? What are your expectations?
I think if you look at the cables and wires quarter, because almost 60% of our sales comes from domestic wires, where there we saw high fluctuations in the raw material prices, hence leading to some restocking in the channel. But if we see the other segment, which is the underground cables, where we saw significant growth of over 25%. So that I think augurs well that the industry, it's a temporary phenomena because the channel has destocked. If you take overall Havells performance without the wires business, then it is almost 14-15% sales growth, which is a very positive outlook for the future.
So, Mr. Gupta, let's, since you seem optimistic, let's talk about the full year projections. Ex of Lloyd, how do you see all the other segments performing and how are you likely to end the year ex of Lloyd?
I think ex of Lloyd is still growing at mid double digits if you look at the 9 months, and I hope that this trend will continue. And this, again, as I said, it's a positive trend. We've seen some consumer sentiment coming back in the third quarter, so it augurs well for the fourth quarter. So it should do well. We've had a couple of quarters where there were some margin pressures in terms of cables and wires or ECD, but otherwise, things should come back to normalized levels very soon.
Hi, Mr. Gupta. Good morning and good to see you and Nigel on this side. I recall, last couple of interviews that we have done, you were indicating second half of the year, you're expecting a bounce back in terms of demand. Are you seeing any signs of slowdown or is demand up to your expectations?
As I said, if you look at the ex-wire business where we saw some channel restocking, but otherwise from a customer point of view, things have started looking positive. There is a mid-teen double-digit growth that we are seeing both in Havells and Lloyd. And I think that is something, if it continues, should be a very positive trend for the company and the economy.
Okay, all right. What about Lloyd? How do you see Lloyd, shape up going ahead and that path to profitability sometime in FY26?
Yeah, I think if you look at overall, 9 months for Lloyd, because it's a highly seasonal product and second and third quarter generally are low quarters for Lloyd. If you look at the entire 9 months, it's a very positive turnaround for the company, both in terms of sales numbers, but also in terms of profitability. And I think this trend should continue in FY26. As you said, it looks very healthy, both from a growth point of view and profitability.
So Lloyd turns profitable, right, on the EBIT front in FY26. That's the aspiration?
That's the aspiration, yes.
Right. Is there signs of revival in the switchgear segment on the industrial side? And could you sort of talk to us a little bit about the margin trajectory here?
Yeah, I think if you look at switchgear, generally for industrial segment is positive. This quarter we saw some decent growth in the residential switchgear also. Margins were under pressure. One of the reasons was also a one-time relocation of a factory. But I think generally speaking, switchgear has remained 38 to 40% normal margin levels, which should come back in this quarter or the next quarter.
To what, sir? We missed that number.
38 to 40% contribution margins are there for switchgear. In this particular quarter, it was lower because of also a one-time relocation expense. But otherwise, generally speaking, it remains range bound between 38 to 40%, which should come back.
So that's the switchgear segment, and probably that would be one of the reasons why the overall blended margins at the company level were also under pressure. There was a a fall of about 110 basis points year on year on Q3 margins. So, Mr. Gupta, again, now I'm talking, all segments put together, blended margins, EBITDA margins. Are you hopeful of a recovery? How are raw material costs moving? And what would the exit margins be? Some rough estimates for FY25.
Again, depends very, very differently on business to business. But as I said, by the exit quarter or fourth quarter, we should be at each business should be at normal levels of margins. Overall, Havells hovers between 12 to 13% Ex-Lloyd, which should come back in the fourth quarter itself. So we are quite positive that the fourth quarter and the next year we should do quite well.
So 12 to 13% margin, ex of Lloyd, and in FY26, Lloyd becomes profitable, right?
That's the aspiration, yes.
Okay.
Okay, all right. What about inorganic growth, Mr. Gupta? In the past, you've hinted about it. You've said whenever there is something, you'll be telling us. Is there something we should be looking forward to in the near future? Because, speculation is that you keep scouting for it and maybe in talks with a couple of players.
Well, I think, that's the job of a growing organization to be always, on the lookout. But as I said, we are very opportunistic about acquisitions. We are also very prudent about acquisitions. And there is enough juice for growth in our existing segments also. So I think, as long as there is opportunity in any acquisition, then only we will be doing it.
Okay, all right. And if you happen to look at inorganic growth, what could the rough ticket size be? If you could help us out with the Capex number as well. I think for FY25, you're hinting at a Capex of roughly around 1,000 crores. Could you refresh our memory with regard to the Capex you've laid out for FY25-26? And in case of inorganic growth, what could the ticket size be?
Well, I think this year again 800 to 1,000 crores. Next year again 800 to 1,000 crores is the Capex projection. We've already laid out, our Capex plans, both in terms of cable expansion, new facility for refrigerators coming up at the Neva facility. So there is a good amount of Capex. And, generally speaking, again, there is no particular size that we have in mind for acquisitions. It depends upon the kind of acquisition. If it's just a small product or technology acquisition, it could be small, it could be a brand or a distribution, acquisition, then it could be a large ticket size. The company is capable of not only through acquiring large numbers to drill networks, but also has raising fundraising capacity as well.
Okay, all right, Mr. Gupta, we'll leave it on that note for today. Thanks for joining in, and I guess it is that promise of things normalizing by the end of the year. On switch gears, margins are going to come back, and overall company margins will revert back to 12 to 13% ex of Lloyd, and the hope on Lloyd itself becoming profitable next year. I think that's what's helping the stock recover some ground. The third quarter obviously was a challenging one. That's Havells